All right, now as the country recovers from the worst recession since World War II, hedge funds are on track for their best year in a decade. Hedge fund assets climbed $21.4 billion in August, the fourth straight month of gains, adding about $100 billion, according to research group Eureka Hedge. And Ken Heinz from Hedge Fund Research says this will be the first quarter of net inflows since last year. Ken joins us to talk more about the hedge fund industry from Chicago. Ken, thanks for coming in. Let me ask you, first of all, why are we doing so well here? Is it purely because of the resurgence we've seen in equities from the bottom in March?
Not really, Matt. That certainly is a big component of the recovery, but that's not the only thing that's contributing to it. Following the worst year of performance in 2008, on average losing 19%, the industry has essentially made back approximately 16% through the conclusion of the first three quarters. Now, I think that that's interesting because a lot of the most out-of-favor areas at the end of 2008, primarily funds focusing on emerging markets, on energy and basic materials, and on arbitrage strategies, particularly convertible arbitrage strategies, have become the most significant positive contributors. All three of those are showing the strongest gains thus far for 2009.
Convert arb is doing, though, the best, up about 43% in the first 8 months of the year. Why is that?
The reason that is a combination of variables. Most importantly, well, I would attribute it to two things primarily. The strong recovery we've seen in credit markets and the resumption of liquidity from the massive dislocations of 2008, where pricing relationships between related securities were very, very dislocated. Essentially, as you've seen liquidity come back into financial markets over the course of 2009, those relationships have been moved to a more efficient dynamic, and that's where a lot of the gains in convertible arb have come from.
So liquidations, even though we hear about, obviously, here and there, some in the news once in a while, have continued to drop for hedge funds. Launches have begun to rise, and fees have come down, which I think is one of the more interesting aspects of what we're seeing going on. Why is that? Is that just because investors are stingier with their money, or is that because hedge funds are getting more competition from other products?
I think it's a combination of variables, really. I think that investors are looking more carefully at I think there's a trend towards transparency. I think investors are looking carefully at the costs associated with it. And managers that are looking to raise capital want to grow, and they're in a position to try to, with some of the good performance, to try to accommodate investors, to bring in significant investors that want to grow with them for a number of years. Matt, I also wanted to point out a number of we've recently put out a report that highlights a lot of the changes in the last year in the hedge fund industry, talking about fees and service providers and liquidations. And for the people out there watching, the viewers that are at their Bloomberg terminal, this report can be easily downloaded directly to your Bloomberg terminal, highlighting all of these changes.
Ken, it's Lori here. With this talk of some new laws supported by the president and the administration, what about the idea to tax capital gains at a higher percentage?
Yeah, there's a number of prospective regulatory initiatives. One of them is the higher tax rate. Another is the prospect of registration with the regulatory authorities. As we've said before, I think it's interesting that a number of funds are already registered with the SEC. Actually, greater than half of all funds in the U.S. are already registered with the SEC. And funds which are registered with the SEC manage approximately 70% of all hedge fund industry capital. Certainly, there's a number of legislative initiatives. The higher tax rate also one. These are currently in process initiatives, and we'll continue to watch how those develop.
Ken, let me just get one more question here. I mean, you, regardless of what we're worried about coming out of Washington, you have put out some new products. There's a lot of new products tracking hedge funds, but you have 6 new indexes tracking performance. What are these all about?
Yeah, that's another one of the trends that I think is really interesting in the industry, is that I think investors are looking for more. The industry has become more sophisticated, both from the manager side and from the investor side. People are looking for more specific types of exposure, and to service that, essentially, we've launched 6 new indices focusing on energy and commodity space. Those are the energy, the HFRX energy, metals, agriculture, alternative energies, energy infrastructure, and an index of funds investing in real estate. All of these are designed to create a point of reference where investors can really observe these qualities.
All right, hey, Ken, thanks so much for joining us. Ken Heinz there, president of Hedge Fund Research.